I think today we'll be wrapping up our example. I'm sure we're going to tie up everything that's been outstanding. And then after that, of course, we can move on to another example. All right. But I'm sure you guys can see now that statement of cash flow. Imagine you're sitting there in the test. You definitely know that they're going to examine your statement of cash flow. Isn't it a better way of us to actually say, let me push as hard as I can so that in the exam I get at least 75. I assure you guys, cash flows, it's very, very much possible to score a very high mark. Very possible. Just practice exam. If you're worried about FAC, right, maybe your mark is way too low. This is actually the time to redeem yourself. All right. But anyways, let's look at where we ended. All right. So I think in regards to the statement of cash flows, right, that we've been working on, we lastly did investing activities, right, whereby we touched that investing activities now, it is actually made up of non-current assets. And then, of course, we did some calculations in regards to investing activities. All right, so now I want to look at financing activities. All right, so to see now what makes up financing activities. All right, so financing activities, guys, we are looking at the way we are funding the business. Right? How did we finance the business and all that? That is what makes up financing activities. So what forms of finance can you think of? Right? Remember from your MSc, the finance side, under sources of finance, you guys discussed that financing activities could be coming from equity and non-current liabilities. All right. Remember current liabilities, all right? You included them under working capital. I believe you guys still recall when you did the calculation of your working capital there, you did include the current liabilities, which means now when you're doing the calculation now for financing activities, you're not going to include this part. All right. So let's quickly see now, all right, in this regard now, to see what makes up the financing activities. All right, just to show you where we included the working capital. All right, under cash flows from investing activities. All right, let's just go to cash paid to suppliers. All right, so that you guys can see. Can you see cash paid to suppliers? All right, what do we have there? All right, the movement in working capital. You see trade receivables, you included there. All right, decrease in interest on trade receivables, provisions. We can all agree that these are our current liabilities. All right, so they do not form part of financing activities. Only non-current liabilities are the ones that we include under financing activities, right? Why? Because the current liabilities, we've already included them on calculating the working capital. All right, so you then go to your statement of financial position. All right, let's just quickly go there and see what is happening. So under statement of financial position, you can see we have equity. All right, so we're looking at equity there, and then we are looking at non-current liabilities. All right, what's your non-current liabilities? Remember now that on long-term borrowings, when we present them in the financials, we do the short-term portion, we present it under current liabilities. Then the long-term portion, we present it under this part. Remember this short-term portion, when you did the working capital, we did not include it there. All right, so in that case, that means this is the only part, all right, from current liabilities, which is included as in the sources of finance there, all right, under financing activities. So let's quickly look into it now, all right, to see what makes up the financing activities, all right, so that we can see what is going on there. So long-term borrowings, they referred us to bullet 6, all right, let's just quickly go to bullet 6 so that we can see what is happening there. All right, so in this case, we have the current portion of long-term borrowing included the short-term borrowings was 7,704,000, and then in 2018 it was 14,701,000. Apart from the current portion, an addition of 10 million of the long-term borrowings were repaid during the year. So right, so in this regard, we can see now there's actually some payments, right, that did actually took place. So let's see what really transpired, right, in regards to this part of the equation there. Right, so on long-term borrowings, right, we can see, let's just draw a T account, right, so that we can see what is going on there, right? So we can start off with our T account, right? So we have long-term borrowings, right? It's looking like this. So we draw a T account. Long-term borrowings. All right. So we draw a T account, all right? So the T account, of course, it would look like this, all right, in regards to long-term borrowings. Right, so in this regard, of course, this is a liability, all right? So these are liabilities. So in this case, if we have liabilities, their opening balance, all right, it will be sitting on them on the credit. So we can have balance BD. All right, what is the opening balance of our long-term borrowings? So it's 34423. So it's 34423. All right, and then we have balance CD. All right, the closing balance for liability is sitting at how much, which is the current year. You can see it's 49308. Right, so that is what we have in regards to the long-term borrowings. All right, so there are two ways, all right, that we can actually normally do, all right, in respect to these calculations. One might choose to say, okay, I want to combine everything, the long-term portion with the short-term portion, all right, so that we just have one amount there. All right, so if you want to do that, all right, so you can then come to your short-term portion, all right, to see what is happening. All right, so you can see short-term borrowings, including current portion of long-term borrowings. They referred us to bullet 6. Let's quickly go to 6 and see. So under bullet 6, the current portion of long-term borrowing included in short-term borrowings was 7 million, all right? 704,000 in 2019. Can you see? So that means this is the closing balance that we have under short-term portion. So you're gonna record it here. So balance CD short-term portion. All right. So here you have your short-term portion looking like this. All right. Let's include it and see. So it was how much? 7,704,000, but we did slash some 3 zeros. So we have 7704. Right. What was the opening balance? So we have balance BD short-term portion. Right, so your balance BD now for the short-term portion, right, the opening balance, which is for 2018, you have 14,701. Right, so it looks like that, right? And then, is there some form of repayment, right, which could have taken place, right, during the year, right? It's important that we have an understanding to see if there's some form of repayment which could have taken place during the year. Let's see. Apart from the current portion payable, an additional 10 million of the long-term borrowings were repaid during the year. Now, can you see? There was actually 10 million, which was also repaid. All right. So in this regard, so you then have bank. All right. So you have bank, long-term portion. All right. So there's 10 million that was paid. Now, what does this mean? All right, I want you guys to understand something in respect to your loan. Now, the reason why we have a short-term portion in regards to long-term borrowing, we are saying this is the amount that we're expecting to pay in the following year. All right, that is why we classify it as short-term portion, which means now in 2018, they classified 14,701,000 as a short-term portion, which automatically means this amount was repaid in 2019. So in that regard, we're going to also have bank, all right, repayment. So we paid the 14,701, all right. And then let's see now if there is some form of how our account will look like at the end of the year. All right, so our closing balance. So we're looking at it like this, right? And then here we're looking at it like this. We can see the credit is actually smaller than the debit, which means there was some form of finance which was raised. All right. So in this case, there's bank as well. All right. We raised additional money, which is 817.13. Just do this. So 81713 minus 34423 minus 14701. All right. So this is the amount that was raised during the year. All right. So it means now we received additional funding during the year. I don't know if there's anyone who's lost so far. All right. Are you guys still with me? Yeah. Cool. So let's record it under, we record it under financing activities. All right. So here we then come and proceeds from long-term borrowings. All right. We received that money, which we said the 3.2. Right. So these are proceeds that we actually received. All right. And then after that, you have repayment. All right. So in this case, this is a repayment of the long-term borrowings. All right. So in this case, you have repayment of long-term borrowings. All right. So in regards to repayment of long-term borrowings, what do you have? All right. You have two repayments there. All right. You have the 10 million that was first paid, right, from this part, and then you have 14701. Right. So these are the repayments that you actually made in regards to the long-term loans. Right. So that is our position. Of course, they have to be negative. Right. So we have it like that. All right. So we're done with this part. And then let's see now. All right. So under short-term borrowings, all right, we're also told now that the short-term borrowings, all right, it looks like there's some form of short-term loan that they actually use. All right. So in this case, let's just amend here. It's equity, non-current liabilities, and short-term loans. All right, excluding trade payables. All right. Let's just do it like that. All right. So in this regard, what is going on? All right. So let's quickly see now in respect to the short-term borrowings, what is going on there. All right. So it looks like the short-term borrowings now, there's a short-term borrowings that was part of the long-term funding. And then there's just short-term borrowings that we actually have. All right. So we now need to look at the part in regards to the short-term borrowings. All right. So let's quickly see what is going on with respect to the short-term borrowings. Right, so we do our tier count there. Right, so short-term borrowings, these are liabilities. So balance, we can have balance BD. All right, so short-term borrowings, balance BD is how much? Now, can you see the short-term borrowings now? They consist of both a portion which came from long-term borrowings and as well as the short-term borrowings. All right, so we have 14,701. This is the portion, right? Let's see how much we have in the statements. So can you see they have 24. So what are we going to do? So balance BD, we're going to take now the 24,791 minus the portion that belongs to the long-term borrowings. We've already accounted for it. Right? So here it's 14,701. Right, so this is what gives us the opening balance. I don't know if I did lost anyone or you guys are still with me then.
We're struggling with, I'm struggling to hear you, the network. I don't know if it's on my side.
Is it?
But yeah, my question was on that 14, that repayment, that 14,701 on the long term, or because they said an additional 10 million of long-term borrowings were repaid during the year. And where do we see that the 14 was repaid? Oh, does it say, oh, because it says apart from the current portion payable?
Yes, so no, what normally happens is this, no? When we prepare the financial statements, we have a loan that is outstanding, all right? So a long-term loan. Statement of financial position. All right, so it looks like this. So we have non-current liabilities. Then we have portion of long-term loan. And then we go to current liabilities. Short-term portion of. Right. Now, what is happening? All right, or what is the logic behind this? Here we are saying the installment on the loan payable in the following year, we record it under current liabilities. Think of it. All right, come to think of it. What are current liabilities? We can agree that current liabilities are the liabilities which are payable within 12 months. That's what it means, right? So at the end of the year, the items that we record under current liabilities, we know that we are going to pay these amounts at the end of the year. That is why with long-term debt, we take a portion of it that we're expecting to pay in the following year, which is within 12 months after end of the year. We record it under the current liability. Then what remains, all right? In this case, what is paid?
I understand. Thank you. Because now you have to just deduct it from the long-term loan.
Yes, that's correct.
Okay.
So in this case, which means now the balance from the previous year, which is 2018, it was settled in 2019.
Thank you, sir.
All right, cool. So that is the logic behind that. I believe you actually helped someone as well. All right, I believe such questions, it was a good question. All right, I believe it also helped someone who was lost to see what was going on there. All right, so that is how we go about that. And then let's look at the short-term borrowings. All right, so the balance. So here we have balance CD, the closing balance. What do we have? Let's quickly see. So we have in the statements, we are looking at 33024 minus, so 33024 minus what? Minus 7704. All right, so it will take us to this amount. So it will take us there. All right, let's see. Is there anything else that was paid in regards to short-term borrowing? It doesn't look like there is, no? So which means the difference between these two, we can see now, all right, in regards to the short-term borrowings, what is going on? Our short-term borrowings, actually, they went up, all right? I'm sure we can all see that our borrowings actually increased, all right? We started off with 1090, all right? And then now it has increased now to, it is increased to 25,320. So that might mean that we actually received some proceeds. All right, so there's some money that we received from some people. All right. So basically, I'm sure we can see that our loan balances actually went up. So it means we might have, all right, we might have received some funding, all right, from some people there. So there's an amount of 15,230. But let us not forget about the subsidiary. Let's see, did the subsidiary come up with any short-term borrowing? Let's see. Remember, there was some acquisition that also took place with respect to subsidiary. Can you see? Subsidiary they have short-term borrowings, which is sitting at 140. So which means this is also supposed to be included in the opening balance. All right. So balance BD, we need to add the subsidiary that we acquired. Subsidiary. All right, so they have 140 there. All right, that would mean now we're going to have so it's going to be minus this. All right, so to take us to 1590. All right, so in this case, under short-term borrowings, all right, so we have some proceeds of some monies that we received there. Proceeds from short-term borrowings. All right, so we received a little bit of some monies there. So we have it as a positive amount. All right, so in this regards, this is how you do your calculation of the statement of cash flows using the direct method. All right, and then you then net off your balances, of course. All right, let's just see if we included everything, all right, in terms of the sources of finance. All right, did we include everything here? All right, so we did. There was an acquisition of subsidiary. We did not sell anything, did we?
No.
There was no sale. Right. So if there was no sale, that is fine. So that's how we go about it in respect to our investments. All right. Proceeds from disposal of equipment. All right. And I think there was also another question, all right, that was asked. I think we missed on dividends. All right, dividends paid. So I think it was Andre who asked about that question. Okay, C is not here. All right, but let's look at the calculation of dividends. Dividend paid, all right, so that we can see what is going on in regards to that. All right, there isn't much involved as well about the dividends, all right? The logic is still the same. So you go to your statement of financial position. to check. All right. So you go to your statement of financial position under current liabilities. Is there any outstanding dividends? So you can see here there is what they're calling shareholders for dividends. Do you see that? So this is the money that you're supposed to pay the shareholders for dividends. All right. You see that at the beginning of the year there is 62.91 that you're owing to shareholders of dividends. It's a trade payable, so it's balance PD. This is the money that you're owing, 62.91. All right. And then what is the closing balance? It's still the same amount, 62.91. So you record balance, we are CD. All right. So it's still 62.91. So that's what you have in regards to your dividends paid. All right. Then you go to your statement of changes in equity. So in the statement of changes in equity, you want to determine now how much dividend did you declare or pay. Remember, dividends, you deduct them in the statement of changes in equity. So you have 11,683. So that was the dividend that was declared. Right? So this is the dividend that was declared. So it's 11,683. All right. So you have it looking like that. All right. Now, the dividend that was declared. Now, how does it work in regards to dividend? Remember now, the dividend that you deduct in the retained earnings is after under retained earnings is after we have deducted the dividend for non-controlling interest. All right. So the portion of the dividend from non-controlling interest. So what we need to do now is to determine how much dividend was allocated to non-controlling interest. All right. So let's quickly see in regards to our non-controlling interest, what is going on in that regard. All right. So we can start off with statement of financial position. That is where we record, isn't it? That's where we record everything. All right. So what is the balance of non-controlling interest? So you can see the balance for non-controlling interest. We have it like that. All right. So let's determine, I want to determine how much dividend was paid for non-controlling interest. So we do non-controlling interest account. Right. So we do the T account for non-controlling interest there. Right. So non-controlling interest is looking like that. This is equity. So balance BD will be here. All right. What is the opening balance for non-controlling interest? It is 7082. All right. And then what is the balance? CD. All right. So balance CD is sitting at 8008. So that's the balance for non-controlling interest. That's what we have. And then after that, so after we have non-controlling interest, remember NCI grows with the profit that we allocated. So let's see how much is the share of profit in the statement of profit and loss. So you then come the profit that you allocated for non-controlling interest. So here you allocated 1148. So which means it increases the opening balance. So profit. All right. So it's 1148. All right. So that's the profit. So 1148. All right. So let's see what is our balancing amount there. So here we have this. All right. So it's 7082. And then here we have 8802, which means now what really transpired. Let's quickly see. 1148. And then Let's check something. $808.
So we acquired a subsidiary. Does that count?
Did the subsidiary
really.
non-controlling interest? Let's see. Why is it? Because now the credit is more than the debit. I just want to see with regards to it. So here's our profit, 1148. That's non-controlling interest. That is fine. Let's see on subsidiary. But usually, no, the subsidiary will not affect because that is the profit that we. Oh, I see. I think it's us.
Your totals were wrong at the bottom on your, yes.
All right, thank you. Yes. So
Then it becomes 222 on the other side, yes.
All right. So now we can see the balance was supposed to have 8230, but however it's 8008, which means there was a dividend that was paid. Thank you. Dividend declared. All right. So in this case, so we have our dividend as the difference between these amounts. All right. So that is the 222. This is the dividend that was paid to non-controlling interest. So we also include it here. So dividend MCI. All right, so we have it as 222 like that. All right. So now let's determine how much is bank balance. How much did we pay in total with regards to the dividend? All right. So we close off our accounts like that. And then that means you can see the credit is bigger than the debit. So that means we paid bank. All right. So it's 18,196 minus 6291. Right. So that's what will give us our dividend balance. So you have 11,905. So you then record that as your dividend. Of course, you record it here under operating activities. All right. So you record here. All right. You can include a line there, which is dividend paid. In that regard, you then have your dividend paid, which is sitting at this balance. All right. So that is how we do the statement of cash flow using the direct method. All right. I think I did show you guys in the previous class about the other part, which is asking for the acquisition of the subsidiary note. All right. And you can check this one. I think I even shared. If you check on the group, I also shared you with you guys on the group, all right, where you can also find this information, all right, on your other book there. All right, so you just go to the other part, all right, B2 of your IFRS, all right, that is where you'll find this note, all right. So in the book, of course, there's a note for acquisition of subsidiary. We are going to look at the note for the loss of subsidiary. All right. It's important that we look at that note as well. All right. And then cash flow from operating activities using indirect method. All right. Like we mentioned, there's direct method and indirect method. The indirect method now, all the calculations we've done. All right. For the components for indirect method, let me just quickly show you how the indirect method looks like. All right, so in this regard, this is our indirect method. It always starts off with profit before tax. So the profit before tax, now you adjust it with non-cash items. All right, so you do adjustments of your profit before tax with non-cash items. Right. Indirect method. Right, so start off with profit before tax. All right, and now in the profit before tax, remember, it includes non-cash items. All right, what are non-cash items? Things like depreciation. All right, fair value gain or loss. All right, you reverse this. I remember depreciation was deducted when we had the profit before tax, so we need to add it back. Fair value gain was added, so we reverse it by deducting it. If it's a fair value and loss, you add it. Profit on self and asset. All right, so profit on self and asset was previously added, so you reverse it by deducting. Then you include items that are presented separately. All right, items like what? Dividends received, dividends paid. All right, dividends received, dividends paid, interest, taxation. All right, so in this case, you reverse all those items. All right, and then you re-enter them separately again. So you can see, can you see dividends received? All right, so they are actually reversing it. And then you see dividends received. Do you see it? Here it is. So here you are now recording the dividend that was actually paid, but here they're reversing dividend that was added when you're calculating your profit. The same applies with finance cost. Here we are not reversing the finance cost that was actually paid, but rather we're reversing the finance cost that was deducted in the statement of profit and loss. All right, so that is how you go about it in regards to the indirect method. All right, so on our next example, which of course we're going to be looking in the next class, we're looking at the statement of cash flows. I'll try to look for the one where there is a loss of control. All right, so maybe we can look at sort of decrease in control. All right, using indirect method. That is if I find the question. All right, that is the most ideal one that I want to look at, the decrease in control using indirect method. So I'll search for that. If I don't find it, then I'll share with you guys the one that I actually found. But I think it would be a little bit interesting to look at that one. All right. Any questions, guys, before we close? All right, cool, guys. If you guys do not have questions, I can say have a lovely evening. Happy studying, guys. Please, guys, cash flows are doable. This is your chance to redeem yourself. Trust me, you'll never get a chance like this. This is your chance to redeem yourself. Let's get it done. All right, we can do this, guys. Have a lovely evening, guys.
Thank you.
All right.
Thank you.
Thank you.
All right, bye, guys.